but this indicates that there may not be enough available gold in COMEX to satisfy current demand.
Welcome to Gold Silver Pros.
Hey everyone, this is Rob from goldsilverpros.com. It is January 6, 2023. I'm recording this about noon Central Standard Time, so all prices and quotes on investments will reflect that time period. We'll put this out probably Sunday evening or Monday morning, which you'll get before the markets open, so you can use to plan out your week and know what is going on. As of the time of this recording, gold is doing pretty well. It's up at 1861.88. It has punched through a key resistance level at 1846, which I just talked about on the show yesterday, which is nice to see gold going up. It's up about $30 on the day, Silver is at $23.79, up 57 cents on the day. Looking at what we saw this week with the major economic reports and data points, we saw the S&P Manufacturing Index come in exactly as expected at a print of 46.2. Construction spending was a little bit below expectations of 48.4. They had it 48.5, so it's about where they thought it would be. Job openings at 10.5 million, quits at 4.2 million. And the FOMC minutes that were released Tuesday at 2 p.m. Eastern time, the Fed basically said they're not going to they're going to continue to raise interest rates. The target right now is about 5.25%. They're not going to continue to ease this year. They don't see the need for it. We'll see if they continue that stance throughout the year. Motor vehicle sales are way down, 13.3 million versus 14.2 last month. Then, of course, the big news is always the jobs report. ADP came in at 235,000, which was a lot higher than expectations of 153, while initial jobless claims came in lower than expected, 204,000 versus 223,000. Continuing jobless claims for those that continue to be jobless up into about a year time frame where they fall off the official numbers is 1.69 million, a little bit less than last month at 1.72. The trade deficit is moderating as we have deflation. We're down now only 61.5 billion a month, meaning we buy 61.5 billion more in merchandise from the rest of the world in the last month than they bought from us. And that's imports over exports. But that has fallen. Last month it was 77.8, and I believe that's because we're in the deflationary part of this multi-stage inflation cycle. S&P U.S. Services PMI, looking at the services market, is at 44.7. It's about what expectations were, slightly higher, although it's negative in terms of it's not accelerating. It is decelerating just a tad. Non-farm payrolls, the big pay report from the government came in at 223,000 new jobs, above expectations of 200, but below last month at 256,000. As a result, the unemployment rate came in at 3.5, a little bit lower than the 3.7 expected. Hourly earnings did raise just a little bit at 0.3% for the month, which is about 3.5% for the year. It does not keep up with CPI, and we'll get those CPI numbers next week. It looks like, to me, average hourly earnings are a little bit less than official inflation. So that means that about 3 to 4 to 5% clip conservatively, wage earners are losing purchasing power per year. Of course, that's looking at the government numbers. If you look at shadow stats and what we think are real inflation numbers, it's much higher, probably around 17 to 20%, or it was, although it's probably coming down just a little bit. Factory orders were a negative 1.8%, meaning that we're not ordering as much stuff, and I believe that's because we're in the deflationary cycle. And the ISM Services Index, another measure of the service economy, was down below 50 at a 49.6 print. That's a slight deceleration. Way under expectations, however. Economists expected the service economy to do a 55.1%. Didn't turn out that way. Looking at the markets, the Dow Jones is trading up 517 points. The headline on CNBC is that stocks stage first big rally of 2023 as hopes of easing inflation grow. Dow up 500. I don't know where they get that, because the Fed was not particularly was not particularly frothy on the economy. I think that's the market just making it up and having a little beginning of year enthusiasm. I don't think that will probably last, but we'll see what happens. So Dow is up 1.57%. The S&P is up 1.57%. The NASDAQ is up 1.61%. And the Russell 2K is up 1.91%. If we look at the bond markets, we're still in yield curve inversion, indicating an oncoming recession. That's why I don't understand the stock markets. The U.S. 1 month is at 4.198, and every Treasury issuance from the 1 month all the way up to the 10-year is in backwardation with the 10-year. In yield curve inversion. The 10-year is at 3.589. Every other issuance from 7-year to 1 month is at a higher rate. That means that bond investors see more short-term risk in the economy than long, which is an indicator of an oncoming recession. If we look at the cryptocurrencies, we have a little bit of red today. Bitcoin is down $44 to 16,807.22. We have Ethereum up $9.61 to 12.62. Litecoin is up 66 cents to 75.35, and that's all the ones that I care to quote to you. Wage growth is down. So there's a chart here from the Labor Department. I'm going to share a screen and show this to you guys. And this situation really kind of depicts what's going on with hourly earnings. As noted, we are on a decidedly downward trend in 22 with respect to wage earnings. So the average that weekly wage earners are earning, the acceleration in that is declining. So in other words, they're still getting more in terms of their wages, but the amount that they're getting more is decelerating. So the rate of acceleration in wage growth is slowing down, and pretty soon we may go to a negative print. We'll have to see. Here's some charts that somebody wrote an article on Zero Hedge and put out there with regard to the BLS report on non-farm payrolls. And what they do is they compare a couple of things. They're looking at average weekly hours on employees. Not only are wages going down, wage increases, but the overall hours that employees can work has gone down since the pandemic. There's also a difference between the household and establishment survey. The establishment survey is a survey that doesn't look at actual households. It looks at proxies for this in the economy, but the actual household survey done actually queries households and is more real data. And the household survey has been for quite some time showing more unemployment than the establishment survey. The household survey was closer to the other unemployment report that we got before the ADP, before they changed it. The ADP now changes to be more like the establishment survey. So now you're getting a lot of playing around with the numbers, and you can't compare past periods for ADP and all that stuff. But it appears as though when you get real boots on the ground data, unemployment's actually worse than what you get through these proxies. And that's shown by these two lines. And this is the difference, about 2.1 million, which is a lot of jobs. Job changes November to December. We increase part-time and a lot of multiple job holders. That means full-time, we did not have an increase. I think it was like -1, so about the same, but part-time jobs went way up and multiple job holders. So when you see a certain amount of jobs in the economy, a certain amount of people, you have to account for the fact a lot of people have multiple jobs. So it may actually be less people employed than the BLS actually believes. And I think that is borne out in the labor force participation survey, which you can see, which is just simply the amount of money, the amount of people in society that can and are willing to work versus employed, and that's down to 62%. So that would be basically a 38% unemployment rate if you consider all those people. And when you add in the fact that we have multiple job holders and part-time jobs, the unemployment situation is not quite as rosy. March to December of a longer time frame, full-time jobs went way down in the economy, part-time went way up, and multiple job holders went way up. Now we're going to switch over to going over gold and silver. We're at the CME's website. We're going to take a look at gold first. We're going to look at volume and open interest. Not a lot going on in the January contract. We're just going to get this year's data, guys. We're in 2023, and this is just the way that they choose to do this. Of course, we can go back if we want into previous months or go forward. It looks like it doesn't look like we're going to go back and get the old data. So it looks like we have 1 day's worth of data here for January. We sell at a price of 18.55. Not much trade going on. Volume of open interest on the February contract. 358,000 contracts, pretty good. EFP 62.14. So in February, there were 6,200 contracts of gold that they went and got the gold, or they went and did price arbitrage with the London market. I suspect that there may not be as much liquid gold on the COMEX because we've seen these EFPs. And what this is exchange for physical between a futures contract in COMEX and the potential for an OTC contract in London, and the potential to actually get that metal, or maybe play price arbitrage between the two products, the two markets. But this indicates that there may not be enough available gold in COMEX to satisfy current demand. That's something that we'll continue to pay attention to. If we look at the settlement data, which tells us where the price went, as of yesterday's data, Thursday, January 5th, we had 190,000 contracts closed on the dominant month of February for gold, and they settled down at about $18.40 to $18.4060. If we look back 1 day at Wednesday's data, again, the February is the dominant contract. Estimated volume for the day, 200,000. Average close, $18.59, up $12. So we've seen a little bit of back and forth on gold. Definitely overall starting the year very well. Looking at the actual depositories, COMEX has lost a fair amount of gold in the last 4 weeks. This is a rolling 4-week chart we look at every week from Nick Laird's site, Gold Charts R Us. So overall, a reduction in the amount of ounces of gold in the COMEX. And if you look here, the last time we covered this, there were 13 million ounces of gold in registered, which is the liquid tradable inventory in COMEX, whereas eligible is private storage and therefore not liquid, unless people want to put it in registered. There's a process to do that. This is down 2 million ounces in just a couple of weeks. So gold is being taken off the COMEX. It looks like the last 4 weeks, about 500,000 out of registered, 300,000 overall off the depository. Some has come into eligible. And if you look at the biggest London holding, which is the GLD, they're showing a a decrease in the metals dating back to silver squeeze. We've covered that a million times. Let's look at the next big one, the iShares IAU ETF for gold. And that one also has seen a runoff. So a lot of physical is coming off. And therefore, overall, you do, however, have a little bit between London and the COMEX markets, a little bit actually coming on the last 4 weeks, although the trend the last couple has been to come off. Going on to silver, we're going to look at volume and open interest. Open interest is pretty much lower than average, starting the year a little bit lightly. Looking at Thursday's data, the dominant contract is March 2023. We had 114,000 contracts at close. We had 600 contracts exchanged between the COMEX to London, presumably to get the 5,000 ounce each contract of silver. If we go back a day and look at Wednesday's data, same thing, 117,000 contracts closed for silver, 408 EFPs over to the London market. Look at where we're settling on these actual deals. We see they're closing. Where's the price going? This is Thursday's settlement data on the COMEX for the March dominant contract. 60,000 closed yesterday at an average price of $23.42, which is silver closed down 54 cents on the day. This is how it's determined. You take all these contracts, you average out the price that they settled at. That gives you the settlement price for the day, and that gives you the spot price. That's how that works. That's why we cover this data every single week. It's telling you how we get to the spot price. Well, on Wednesday's data of this week, the trade for the March contract, futures contract, 64,617 contracts to settle at an average of 23.96, down 27 cents. So overall, that's the trade in silver. If we look at the actual storage of silver and we look at COMEX, there's actually been a net increase in silver, I would say, of about 2.5 million ounces over the last 4 weeks, although more of the silver is coming off of London. So there's been a little bit of silver that started to come back to COMEX, a lot more moving off to London. We only have 34 million ounces in liquid silver in COMEX, however, so if there's any sort of run, this could be taken out pretty quick, and then we would see if any of the eligible private contract wants to be put back into the liquid trade and registered. That's up to the individual owners, not to the exchange and not to COMEX. Lastly, we're just going to take a look at this report, and this is the CFTC COT report, or the Commitment of Traders. This data table for several metals, which is produced every week, tells us how each of the individual groups of traders are repositioning. What that tells us is who thinks it's going long, who's going short, and also tells us maybe what the direction of the trade could be moving forward based upon how many contracts are added long and short and who's doing that. Now, this data is as of December 27th. It's usually about a week to 10 days old. So this data is going to tell us where the prices went here. Essentially, this is backward looking. There has been a big change in silver. It has been several months in which the swap dealers, or the bullion banks, what I call the sharps on the market, were net long on silver, pointing to an increase in the silver price, which did happen. We got up to $24. Well, now they're net short by about 7,000 contracts. They added 2,127 short contracts for the week and subtracted off 160 long to go net short for the week's trade of about 2,300 contracts. And so I think now the swap dealers are expecting the price to go down. The managed money is very, very, very long silver. They look to be the dupes in this trade. They'll probably lose money on it. Of course, the producer merchants are net short, as we would expect. They're hedging downward price risk for the silver that they are going to sell in the market. The other reportables are now slightly net long, but moving more to a net short position slightly. And so it looks as though a lot of the smart money on the market's expecting silver to actually fall. I wrote an article for 𝘎𝙀𝘾𝙊𝙈 Bullion's blog last week, I believe, where I looked at the Bloomberg terminal and I looked at what were the price predictions for silver for the next 2 to 3 years. There were several banks and in the swap dealer category which had $17, $18 price targets. There are bullion banks that think the price of silver is going to come down before it comes up. That is entirely possible. I have, in a preview of silver for 2023, mentioned that on 𝘎𝙀𝘾 Bullion as well, the price range could be from 11 to 30 this year, or we could see it go over 30 if we have a big geopolitical event or meltdown in the economy that forces people into silver as a monetary asset. But regardless of that, if we just have general deflation, inflation cycle this year and what people think is going to go on with the economy, I expect silver price could fall in that initial sell-off and then rise again. And I think the banks are looking at like a $17 target on silver if it does sell off. That also tends to indicate to me that we're going to have a much bigger, broader market sell-off that's going to affect silver and gold paper trade. But I think silver and gold will rebound faster because they typically do. And we'll cover that more in 2023 as we go. Here is gold again as of December 27th. They are very short gold, the swap dealers, 202,000 contracts to 91,000 long. That's more than a 2-to-1 ratio. Of course, short, the producers make sense. They're hedging their price risk till they get the metal to the market. They want to get as much as they can. So they take a short to hedge downward price risk. If the price falls, they make money on the contract to offset the price they lost on the physical commodity. That's called legitimate hedging. They're basically, this is the only group that does legitimate hedging most of the time. There could be some legitimate hedging in here, but honestly, with all the ounces they have here, I don't think a lot of producers are using it. Managed money is about double long gold. They're 106,983 contracts long, only 56,106 short, and as are the other reportables. The family offices and wealthy individuals are almost 4-1, 122,000 long to 3,600 short. Overall, I expect the gold and silver will have a very adventurous year. It looks like people are positioning for different directions in gold and silver for the year. We'll pay attention to that because it matters, because that's what drives price. But the big news here in terms of the bullion trade is the bullion banks have gone net short silver. I expect, therefore, silver to maybe drift off a little bit in price until that's adjusted, unless the rest of the market comes in heavy on the long side and takes the opposite side, those bullion banks, and decides to bid it up. That is entirely possible. We'll see what happens. Unemployment report, not quite what we expect. I think we covered that here. It's not quite as rosy as we expect. So we'll continue to look at fundamentals going through the rest of the year.
Searching for the best precious metals deal? Shop with our trusted partner, Arc Silver. Access special deals on silver, gold, and platinum through our website, or call 307-264-9441.
Hey everybody, we're back with the weekly market wrap up with the metals with Ian of Arc Silver. Ian, how are you doing today?
I'm good, Rob. It's good to see your smiling face. You're looking good.
Thank you very much. Good to see you as well. You gave me a call earlier this morning, Ian, and you had this theory, this epiphany, I guess I'll say, on what's going to happen in the economy. And it does appear, just to kind of set this up for people, it does appear that there tends to be some pushback on what the global plan is that we talk about all the time. And it appears as though people are making some progress. And perhaps that could be some good news for people. But I think you have a theory on this. Why don't you enlighten us as to what your view is?
Yeah, sure. So the elites, the Federal Reserve, the central banks, whoever owns the world or think they own the world, they have a problem. This existing financial system is going to blow up. It is blowing up. We've had tremors, the British pensions. We've got the European banks, Deutsche Bank, Credit Bank, Commerce, Credit Suisse, BNP Paribas. They're all teetering on the brink. They're all about to blow up. We've got countries about to implode, Germany, Europe, the euro, on and on and on. So we've got crises happening and about to happen, coming at us from all angles. It's not a black swan. It's whatever the collective name for a group of swans is. There's a 10, 20, 30 things that could trigger a systemic financial breakdown. So things have come to a head because I believe they want an excuse to do a reset into a fully digital system. We're close there anyway. Most transactions are monitored, controlled, recorded. But their objective is to get us into a fully digital currency. Now, the problem with that is, if you bring all the perceived wealth into the new system, it's just as fragile as the old system. That won't work. So you've got to burn off, when I say you, the system has got to burn off or trap an awful lot of perceived wealth. So they need bag holders. So thinking they got this wealth, thinking they can use it in the future. And that's got to get stranded on the other side behind the new digital dollar. And so this morning I've been pondering on it, and I heard somebody else talk about it on Monaco 64 a week or so ago. And I'm convinced this is how they can do it and make it work, at least for a few years. So
real quick before you get in that, I'm going to kind of set this up a little bit. So what we've been talking about, I think a lot of people have been talking about in the alternative media, is the new system, central bank digital currencies, replacement of the paper dollar, maybe destruction in the debt system, some sort of either debt forgiveness or debt destruction that would flush out a lot of the junk in this system and allow it to do the reset and have, another version of the dollar emerge perhaps. So that's kind of what we've been talking about. And what you're about to outline is maybe a mechanism for how that could take place. Sorry to interrupt you. Go ahead.
Yeah, no, sure. So I'm convinced their plan, and it will use a crisis as a smokescreen. So something will cause the whole banking system to freeze up, go ice 9. I think that's a Jim Rickards phrase. Everything just freezes, nothing moves. A bit like 2008, but a whole lot worse. And this time, printing up 40% more currency won't work, because they did that over a few years last time, and before that they did that over 16 years. This time they'll have to do it in months, if not weeks. That won't work. The public won't swallow it. They will realize the dollar is worthless, the euro to pound is worthless, and then that's the end of the currency. So they need a crisis, a smokescreen. And if that crisis doesn't come along quick enough, and people do realize that the fiat currencies are dead, well, that will cause the financial breakdown, freeze that they need as an excuse to do the reset anyway. So whatever happens coming forwards, there's a crisis coming. So what will happen? You get your new digital dollar, and since 90%, I don't know, maybe 80–90% of Americans probably don't have more than a few thousand in their bank accounts. As long as that moves into the new digital dollars and they get a sweetener, maybe 3,000, 5,000, 10,000 digital dollars, they'll be happy. They'll carry on going to work. Everybody be buying, selling. You'll be able to fill up your car with gas. Everything carries on. No dystopian breakdown. No Mad Max. No sinking into bartering. But what happens to the people who've got more than 10,000 or 50,000, or whatever the amount they've decided? That will stay as old dollars, and they'll say, well, this will get transferred through in a few weeks and a few months when the system's stabilized. Don't worry, you've got enough to keep going for now. Maybe you can do 20,000 a month. But at some point, people will realize the old dollars won't be allowed to pass through into the new system, the ones that have been left behind. It'd be like a whale, a stranded whale on a beach. It's there, it exists, it's a whale, but it's going to die. And so these dollars that get stranded are going to die. So you've got people who've done a sensible thing, gone to cash to get out of stocks and bonds and all this crazy stuff, even out of real estate. But if they don't understand what is going to happen, that cash will get stranded. They'll have enough to live on. They'll get transferred through to the new system. And also what this would very conveniently do, they can decide whose debt gets left behind in the old system. So my mortgage probably will get ported through to the new system, and I'll owe it in new dollars just as much. They may even reset the interest rate. But you can bet your life that the Federal Reserve's debt, the US government's debt, will get left behind in old dollars. And what's another nation going to do about that? You know, and say a nation, say China owes $1 trillion of US debt. Well, be hard luck, see? Like you're not getting your money back. You're not getting that value. I can't see any other way how they can bring in a fully digital currency that will survive after a crisis without burning off wealth, perceived wealth, and debt. And they can be very selective. Who are the winners, who are the losers? The winners will be the ones who are connected to the people who are making these plans. They'll be front running. So I think you asked me this morning, Rob, well, what will the signs be? Well, I think the metals will start to move, because that's the obvious place. There's not much better I can think of, if anything better, than precious metals. Very little or no carrying cost, absolute privacy. And the next best is farmland, maybe with little or no carrying cost. But for most people, they're blissfully unaware their wealth is trapped up in financial instruments, and it will be arbitrary which ones survive and which ones don't.
And so this is sort of an artifact of previous systems where they reset to paper currencies. They would reset to gold. The old paper currency would be a lot less valuable, and people would, burn it as firewood, to use it to build houses in some cases. So that could be what happens to the dollar. What happens to the debt system? Is there going to be debt forgiveness or debt destruction? Because I don't think the new system, they're going to want to lay it. They're not going to want to burden it with all the debt that they have in the existing system.
No, and the bulk of the unsustainable debt is the government debt and the central bank debt. Their losses now are just racking up in the tens of billions a day. That's unsustainable. It can never be repaid. So that will disappear. But somebody's mortgage, who probably just as likely can carry on earning and pay it down over the remaining term, that will get transferred. We had some history from the Weimar hyperinflation period. Personal debt got transferred through, but big business debt didn't, or it didn't get re-rated into the new currency. It stayed at the old level, so therefore it disappeared. And
Of
there's going to
course.
be
And
nuance.
so what that does is bail out the big entities,
Exactly.
right? While putting the burden upon
Yep.
the small people. And I wonder if mortgages flow through the new system, wouldn't you have to acquiesce to that? Because contracts written in the old system, wouldn't you have to sign off on that? So maybe they incentivize you to do it. I'd stay in the old system and just pay it off. I mean, you pay it off with gold, silver if you have a little bit. Is that going to be possible?
Yeah.
Because if I'm looking
There
to go in
may
this new
well-
system, I'm like, no, I'm not going to the new devalued dollar. I'm going to,
Sure.
or the new dollar. I'm
Yeah.
paying off in the old devalued ones.
There may well be an opportunity there if you get a choice, or there may be a transition period where it's in the old, your debt is in the old system. And if you have a tangible asset that you can sell, you might be able to buy old dollars. There might be a secondary market for the old dollars that are trapped that can't go into the new dollars, and use the old dollars to pay off old debt. There is that possibility. Yeah.
All right, very good. Well, we're going to explore this more in coming episodes. I think there's a lot more there to talk about. But let's get on to the metal. How are the metals doing? What are you seeing in the metals market? Is it frothy? Prices have been up for sure. It's been a nice start to 2023. What's going on in the physical markets?
Yeah, wholesalers are still, we just refreshed the spot. So we're 23.80. So we've been up and down to 24.5, down to 23. A lot of volatility there, which is not quite sure what that reason is, whether it's manipulation or it's just as we're heading towards, now we just jumped up to 23.90. I never remember it moving this much, $1, and a half in a day, up and down, up and down. Whether that's deliberate to scare people out of buying, I don't know. Wholesale premiums are still falling. They're the lowest I've ever seen on most products now.
Oh, the wholesale premiums are.
Yeah. Not
so
on
that's
retail yet.
Transmitting to people at the retail level. It seems like premiums have come down. We were looking at 10-ounce silver bars, and it's between, I think, 3 and 5, maybe depending on where you go and what type of bar you're looking at.
The retail spread seems to be widening I guess we're dealers, we all look at each other's prices when we've got time and there's comparison sites. The spread seems to be widening between retail and wholesale. That's partly because the bigger companies probably got caught with a lot of inventory that they've paid a higher premium at.
How are you handling that, Ian? Because I know you had some inventory as well. Did that affect you? Because I know that several bullion dealers did exactly that there were high premiums they paid. Now it's going to be difficult for them to make money, so they may hold back inventory for a while.
Yeah, thankfully I bought incredibly heavily at 19 and then backed off. I've been buying all the way down from 26. So cost averaging down, not up.
Okay.
But I don't value my inventory on a mark-to-market basis because I'm not selling all my inventory. It moves, ounces coming in, ounces go out, or ounces go out, ounces come in. I just count ounces. And as long as I can just gently keep increasing my ounces, I know in maybe in months it will pay off. So it's not about earning dollars now. It's about building ounces.
Okay. So what type of deals do you have for people that are interested in silver?
You name it. We've got silverback rounds, a $1.95 premium. We've got 100-ounce bars, $1.60 premium. Got some nice, one of your favorites.
Oh, it is my favorite, the Royal Canadian. Yeah.
These are the mint from Britain. Yeah, we've got those. We've got all the silverback range. We've got eagles, maples. Yeah, pretty well everything.
Awesome. So how do people reach out to you if they're interested in buying bullion?
Go through Rob's link, and then that helps his channel, keeps him fed and watered.
Yep. Go to goldsilverpros.com, click on the ARC link, and we'll put that down in the description, the direct link to that form in the video description. All you guys got to do, click on that, fill out some basic details, and Ian will get back to you. All right, Ian, that's awesome for this week, man. Thank you so much for hopping on. Appreciate it.
You're welcome. Thank you, Rob.
Hey, thanks for watching. We selected these videos just for you. Check them out. And remember, $4.99 a month keeps the lights on and the channel going. So join our Gold Silver Pro supporter membership. We appreciate your support. Keep stacking.